In December 2008, while the world was drowning in financial crisis, a different kind of collapse was happening in a quiet Manhattan office tower. Bernie Madoff, respected financier, former chairman of NASDAQ, philanthropist and Wall Street legend, sat across from his two sons and said 5 words that would destroy everything. It's all been one big lie. $65 billion gone. Not lost in bad trades or market crashes, stolen. For nearly 2 decades, Madoff had been running the largest Ponzi scheme in history right under the nose of regulators, investors, and even his own family. Charities evaporated overnight. Retirees lost their life savings. Banks collapsed. Fortunes that took generations to build vanished in an afternoon. But here's the thing. It wasn't complicated. There was no sophisticated algorithm, no exotic derivatives, no offshore shell game. It was simple, absurdly simple, and that's exactly why it worked. Welcome to paper empires, where fortunes are built on lies. Bernard Lawrence Madoff didn't look like a criminal. He looked like success. Born in Queens in 1938, the son of working-class Jewish immigrants, Bernie started his investment firm in 1960 with $5,000 he'd saved from lifeguarding and installing sprinkler systems. He was 22 years old, newly married, and ambitious. His wife Ruth kept the books. They worked out of a small office, nothing flashy, just steady, honest work, or so it seemed. By the 1970s, Madoff Securities was thriving. Bernie had built one of the first electronic trading platforms, helping modernize Wall Street. He wasn't just successful, he was legitimate. He served on industry boards. He advised the SEC on market regulation. In 1990, he became chairman of NASDAQ, the second largest stock exchange in the world. People trusted him because he was the system. He didn't operate in shadows. He shaped the rules, and that gave him the perfect cover. Here's how a Ponzi scheme works. It's named after Charles Ponzi, an Italian con man who ran the same scam in the 1920s Boston. The mechanics are brutally simple. You promise investors unusually high returns, steady, reliable profits that beat the market. New investors give you money, but instead of actually investing it, you just pocket it. When the early investors want their money back, you pay them with cash from newer investors. As long as more money keeps coming in than going out, the illusion holds. It's a financial perpetual motion machine. Impossible, but beautiful as long as no one looks under the hood. Madoff's version was elegant. He didn't promise outrageous returns, 15% or 20% a year, nothing flashy. Just steady, consistent gains. In good markets and bad, Madoff's fund never seemed to lose. That was the hook. While everyone else suffered through crashes and corrections, Madoff's clients slept soundly. He called it a split-strike conversion strategy, buying blue-chip stocks and hedging with options to minimize risk. It sounded technical, boring even, and boring is trustworthy. But none of it was real. There were no stocks, no options, no trades, just a Microsoft Excel spreadsheet and fake account statements printed on expensive paper. When clients wanted to withdraw money, Bernie paid them with deposits from other clients. It was a shell game played with billions, and for nearly 20 years, nobody caught on. Why did it work so long? Because Madoff didn't target fools. He targeted the elite. His clients weren't desperate gamblers chasing quick riches. They were hedge funds, international banks, universities, charities, and celebrities. Steven Spielberg, Kevin Bacon, Elie Wiesel, the owner of the New York Mets. These weren't people easily fooled. They had lawyers, accountants, and financial advisors scrutinizing every move. But Madoff had something better than credentials. He had exclusivity. You couldn't just invest with Madoff. You had to be invited. He turned people away. He made it feel like a privilege to give him your money. Country clubs whispered about him. Wealthy families passed his name like a secret. If you were in, you were part of an inner circle. If you weren't, you were nobody. Psychologically, it was genius. Exclusivity creates trust. When something is hard to access, we assume it's valuable. When everyone around us is invested, we stop asking questions. Social proof replaces due diligence, and Madoff exploited that perfectly. He built his scheme not on greed, but on belonging. Except someone did see them. Multiple people, actually. In 1999, a financial analyst named Harry Markopoulos began investigating Madoff's returns. The numbers didn't add up. The consistency was statistically impossible. Markopoulos ran the math and concluded there were only two explanations. Madoff was either front-running his clients' trades, using insider information illegally, or running a Ponzi scheme. Markopoulos reported his findings to the SEC not once, not twice, 5 times over 9 years. He handed them a 21-page report titled, "The World's Largest Hedge Fund is a Fraud." He explained in detail why the returns were impossible. He showed them the red flags. Madoff's auditor was a tiny 3-person firm operating out of a strip mall. The fund had no independent custodian. The trading volume required to execute Madoff's strategy didn't exist in the market. The SEC investigated Madoff multiple times. They visited his office, they asked questions, and every time they walked away satisfied. Why? Because Bernie Madoff was charming, respected, and one of them. He was a former NASDAQ chairman. He sat on regulatory boards. He knew the game better than the referees. When investigators came calling, he gave them just enough to seem cooperative. Fake trading records, industry jargon, a confident smile. They wanted to believe him, so they did. This is the second lesson of the Madoff scandal. Institutions don't catch fraud when the fraudster is the institution. By 2008, the global financial crisis was in full swing. Lehman Brothers collapsed, markets crashed, investors everywhere were panicking, pulling their money out of funds. And that's when Madoff's machine broke. A Ponzi scheme only survives as long as new money flows in faster than old money flows out. But in a crisis, everyone wants their cash back at once. In December 2008, Madoff faced $7 billion in redemption requests. He didn't have $7 billion. He didn't have any of it. On December 10th, Bernie called his sons Mark and Andrew into his office. He was calm, almost relieved. He told them the investment advisory business, the crown jewel of Madoff Securities, was a fraud. One big lie, he said, all of it. His sons were devastated. The next day, they reported him to federal authorities. On December 11, 2008, FBI agents arrested Bernie Madoff at his Manhattan penthouse. The final tally, $64.8 billion in reported account balances. The actual money invested over the years, around $20 billion. The rest was fabricated profits that never existed. The fallout was catastrophic. Charities that had invested their endowments lost everything. The Elie Wiesel Foundation for Humanity, created by a Holocaust survivor to promote peace, was wiped out. Retirees who had trusted Madoff with their pensions faced poverty. Banks that funneled clients to him faced lawsuits and collapse. Some victims committed suicide. Others spent the rest of their lives trying to recover pennies on the dollar. The trustee appointed to recover funds clawed back money from investors who had withdrawn profits because those profits were stolen from other victims. Madoff himself showed little remorse. In interviews, he remained calm, almost detached. He pled guilty to 11 federal felonies and was sentenced to 150 years in prison, the maximum allowed. He died there in 2021 at age 82. His wife Ruth lost everything. His sons were destroyed. Mark Madoff hanged himself in 2010 on the second anniversary of his father's arrest. Andrew died of cancer in 2014. The Madoff name became synonymous with betrayal. Here's what the Madoff scandal really teaches us. Fraud doesn't survive because it's clever. It survives because we want to believe. We want to believe that steady returns are possible, that exclusivity means safety, that respected institutions wouldn't lie, that people like us, smart, careful people, couldn't be fooled. But the biggest frauds don't exploit ignorance, they exploit trust. And trust, once institutionalized, becomes nearly impossible to question. The SEC didn't catch Madoff because he was one of theirs. Investors didn't question him because everyone else believed. Analysts ignored red flags because the social cost of being wrong was greater than the financial cost of being scammed. And that's the uncomfortable truth. Madoff didn't fool the world fooled itself. He just gave people permission. In the end, the $65 billion lie wasn't the fake trades or the forged statements. It was the belief that someone, somewhere, had figured out how to beat the system without risk. That belief is what keeps every Ponzi scheme alive, whether it's run by a con man in a penthouse or by central banks printing money they don't have. History repeats because human nature doesn't change. The names shift, the numbers grow, but the lie stays the same. Trust us, we're different. They never are. If this story opened your eyes, subscribe to Paper Empires. History has the answers, and we'll show you where to look.